Developments are moving fast in Nigeria's economy right now, from policies shaking up businesses to moves that could change how we trade at home and abroad. There's a lot happening and it affects everyone, whether you're running a company or just managing your money. Hello and welcome to Market Square, your go-to show for deep insights into business and economic trends. I'm Olaitan Adebayo, and today we are breaking down key developments across Nigeria. Stay with us. The new Nigerian Tax Act, taking effect on January 1st, 2026, is being described as one of the biggest reforms the country has seen in years. Government officials say it is meant to make the system fairer, raise more revenue, and reduce the leakages that have held Nigerians back for decades. But what most Nigerians will feel immediately are the penalties attached to the law, because the government clearly wants to end the era where people ignore tax rules without consequences. A good place to start is the motivation behind this act. For a long time, many individuals and businesses either refused to register, did not file returns, or simply asked like taxes were optional. This made it hard for the government to fund infrastructure, public services, and even basic national responsibilities. The new tax law is coming at a time when oil revenue is unreliable, and the government can no longer afford weak tax compliance. That is why this act leans heavily on enforcement. It does not just encourage compliance, it demands it. Under the new rules, even simple things like failing to register a business, delaying tax returns, or not keeping proper financial records now attract serious financial penalties. For instance, a business that refuses to register will now pay 50,000 naira in the first month and 25,000 naira for every additional month, while anyone who delays filing returns, especially VAT returns, will face 100,000 naira in the first month and 50,000 every month after. Even failing to keep proper books now attracts 50,000 naira, and this amount pile up quickly. The idea is to make it more expensive to ignore the law than to obey it. Previously, many people would delay filing for months because the penalty was small, but now the fines start high and keep adding up every month. It's a government way of saying you can no longer hide in the shadow. A major shift in this act is the push for digital monitoring. Tax authorities want to track transactions and business activities in the real time. This is why refusing to give access to their digital tools comes with extremely heavy consequences. The penalty begins with 1 million naira for the first day and 10,000 naira for every additional day. The research continues. It is a kind of pressure no business can easily ignore, because the government is clearly moving towards a system where technology will close loopholes and reduce the chances of manipulation. Another area the law focuses is the treatment of taxes that businesses deduct on behalf of the government. The new tax takes this very seriously. When a company deducts tax from a customer or an employee and fails to remit it, the government sees it as holding on to funds that does not belong to them. Failure to deduct attracts a penalty of 40% of the amount that should have been deducted, while failure to remit what was deducted means the business will pay back the full amount plus 10% annual penalty, and the interest is based on the CBN rate. In more serious cases, failure to self-account for tax also attracts the tax due, plus another 10% per year as penalty. This is meant to discourage the common practice where businesses hold government taxes to support their cash flow. The act also addresses something many Nigerians have complained about for years: the habit of stalling, delaying, or refusing to provide information when tax officers request it. Now, ignoring a tax notice comes with 100,000 naira on the first day and 10,000 naira each day after refusing to provide documents. Refusing to provide documents starts at 200,000 naira for the first day and another 10,000 naira per day as long as the refusal continues. Even failing to update a change of address now comes with 100,000 naira for the first month and 5,000 naira for every month after. In short, if the tax authorities reach out, silence now comes at a cost. Businesses operating in this digital and virtual asset space are also under tighter scrutiny. Companies dealing with crypto or digital assets that fail to comply will face 10 million naira in the first month of default, with 1 million naira added every extra month, and they may even lose their operating license entirely. This signals that digital economy is now fully within Nigerian tax nets. Some part of the law go beyond money and move into criminal territory. Fraud, forgery, impersonating tax officers, bribing officials, or obstructing tax enforcement can all lead to prison sentences. For example, forging stamp attracts fines that can reach 2 million naira, and offences involving improper handling of taxable documents also attract penalties or imprisonment. The Act even addresses extreme cases. If a person carries a weapon or injures a tax officer during a tax-related operation, the punishment can go as high as 5 to 10 years in prison. This shows how seriously the government wants to protect tax officials and the integrity of the tax system. What all this means for Nigerians is very simple. The tax environment is about to become much more stricter. Businesses will have to be more organized, more transparent, and more timely in their reporting. Individuals will have to pay closer attention to their records, deductions, and obligations. And the government will be expecting far greater compliance than before. The era of casual tax compliance is over. The new tax act is sending one message: accountability is no longer negotiable. While the new tax act continues to shape conversations around compliance, manufacturers are also raising concerns about lending conditions. The conversations around Nigerians' interest rates is eating up again, especially after the latest MPC meeting. And once you look at what manufacturers are dealing with on the ground, it's not hard to see why they are frustrated. Borrowing is still expensive, production costs keep rising, and the central bank's decision to keep the benchmark rate at 27% is making people in the real sector ask, how much longer can they cope? The CBN is looking at inflation and exchange rate stability, saying the economy is starting to find its balance, but manufacturers are looking at their factories, their loan repayments, and their shrinking margins, and they're saying this policy stance is squeezing them harder than ever. The DG of Manufacturers Association of Nigeria, Segun Ajayi-Kadir, said manufacturers had hoped for more than just a pause. They wanted a cut because borrowing today is sitting between 30 and 37% for many factories. And when borrowing is that expensive, production slows down, expansion plans are abandoned, and competitiveness drops sharply. So while the CBN is focused on inflation and exchange rate stability, manufacturers are saying the real sector is being suffocated. The association argues that high interest rates are coming on top of an already difficult operating environment. Companies are still dealing with poor roads, unreliable power, high diesel prices, rising logistic costs, insecurity in industrial and farming zone, and raw material shortages. With all of these challenges, they believe credit should not be this expensive, especially for small and medium-scale manufacturers who are already struggling to stay afloat. The argument is very simple. If Nigeria wants to grow local industry, if the country wants cheaper goods, more jobs and stronger exports, then borrowing must become more affordable. And they are asking the CBN to reflect that reality in future policy decisions. They also want new monetary tools that push credits directly into the real sector while the government handles the infrastructure gap from fiscal side. Beyond the association, other members of the organized private sector are saying the same thing. The Lagos Chamber of Commerce and Industry agrees that the MPC's decision shows an attempt to maintain stability, especially with inflation almost at the CBN's target for December. But they are also hoping to see a downward review soon. Once the bank feels confident that inflation is firmly under control, small-scale industrialists share the same view. They say holding the rate cut at 27% suggests CBN is comfortable with the direction of the economy and does not want to trigger any sudden shocks. But even without understanding, the private sector is still making it clear stability is good, but without lower rates, investment will remain low. The CBN is watching inflation, while the manufacturers are watching their cost of production. The question now is when both objectives can align, because the more economy stabilizes, the louder the calls for cheaper credit will become. For Nigeria's industrial sector, the next MPC meeting will be critical in determining whether growth will accelerate or continue to be held back by expensive loans. But despite these orders, Nigerian secured an important global quality certification that could boost exports. Nigerian just recorded one of its biggest wins in years in the global trade space. For the first time, the Nigerian National Accreditation System has secured international recognition. Now, this may sound like a technical achievement, but in real economic terms, it opens Nigerian's products to over 140 countries without usual suspicion, retesting, or outright rejection that's cost exporters millions of dollars. For exporters, this is huge. For the economy, it's even bigger. Nigeria has been losing millions of dollars every year because of its products, especially food items, were being rejected in Europe and America. Not because the products were bad, but because foreign countries didn't recognize Nigeria's testing and certification system. That problem has now been fixed. With this new status, any certificate issued by the accredited laboratory or inspection body will now carry globally trusted marks from top international bodies. Only 8 accreditation systems in Africa have this level of approval, and Nigeria has just joined the list. The recognition didn't just happen overnight. It's coming after almost 15 years of work under the National Quality Policy. What it does is simple. It aligns Nigeria's entire quality system with the global standards, giving confidence to international buyers, investors, and regulators. This development directly addresses one of the country's biggest export pain points. Exporters who use the accredited testing and certification routes can technically achieve zero rejections because of the destination countries will now accept their certification outright. For manufacturers and micro, small, and medium enterprises trying to break into foreign markets, this removes one of the biggest bottlenecks at the port and custom checkpoints. It also means Nigerian products should enjoy smoother passage under the African Continental Free Trade Area rules, opening more doors across Africa. If you produce, test, and certify through a recognized system, your goods will not be stuck in borders delay caused by quality disputes. The United Kingdom, which supported a lot of the quality reforms, said the achievement sends a clear signal. Nigeria is ready to compete globally. UK officials noted that the recognition recognition will reduce trade barriers, boost investor confidence, and open new markets for Nigerian producers. Essentially, foreign buyers will be more willing to source goods from Nigeria because the quality assurance system now meets global expectation. Right now, the UK import from Nigeria stands at about £2.3 billion, mostly in raw commodity. But with this recognition, Nigerian products, especially processed goods, can pass through UK customs more easily, with fewer delays and fewer rejections. The broader economic implication is that Nigeria is gradually building a more credible export ecosystem, something policymakers have been pushing as the country tries to diversify earnings away from oil. If exporters begin to see fewer rejections, quicker clearance, and lower compliance costs and directly translate into higher foreign exchange inflows, stronger competitiveness, and better support for local industries. This recognition doesn't just improve quality control, it strengthens the entire value chain that connects Nigerian producers to global buyers. And beyond global markets, experts say Nigeria must also strengthen its place within Africa's $3.4 trillion single market. When we talk about Africa's economic future, one topic keeps coming up: the African Continental Free Trade Area. It's the agreement that is supposed to open the entire continent as one big trading market. But for many people, it still feels like something far away, something only policymakers discuss. That's why the summit happening in Abuja is important. It's the first trade bloc public-private press summit. It is Nigerian chance to show how serious it is about taking a leadership role in the single African market. The meeting brought together government officials, private sector leaders, and development partners to evaluate how far Nigeria has gone and what work still needs to be done. After going through the statement from Abuja, Nigeria is trying to take a front row seat in the African single market. The summit is not just another government event. It's where the country is basically saying we want to lead this process and want the benefit to reflect at home. The Minister of Industry, Trade and Investment, Dr. Jumoke Oduwole, made it clear that the African Continental Free Trade Area is one of the biggest economic projects in the world, a $3.4 trillion market with 1.4 billion potential customers. And for Nigeria, tapping into that market is not optional. Our economy depends heavily on how well we play in this space. When African countries trade with each other, value stays inside the continent instead of leaking out. Nigeria is already trying to position itself early. For example, we became the first country to ratify the Trade Bloc Protocol on Digital Trade. That gives our tech companies, fintech, and digital service providers a head start. It means Nigerian digital products can reach other African countries faster with fewer regulatory blocks. But the trade bloc is not just a sign and celebrate agreement. It's a practical day-to-day process. Customs, immigration, port, logistics, all these systems must work together. That is why the minister praised the customs and immigration services. If border processing remains slow and heavily manual, the agreement's benefits won't reach businesses. The whole idea is to reduce delays, cut costs, and make trade smoother across borders. The conversation at the summit also focused on what the single market should mean for ordinary Nigerian. It's not enough to say there is a big market out there. The benefits must show as jobs, higher income, and new opportunities for small businesses. The minister stressed diversification, especially manufacturing, agro-processing, textiles, and digital services, because those are the kinds of products African countries actually trade with each other. There is a call for coordinated action needed from the government side. Agencies cannot continue to work in silos. If ministries, customs, immigration, exporters, and private sector groups are not aligned, progress under the agreement will remain slow and frustrating. As the summit continues with technical sessions on trade, goods, services, digital commerce, investment rules, and regulatory harmonization, one thing is becoming clear from all of this conversation: Nigeria is positioning itself to play a major role in the era of single African market. The country has made progress, especially with digital trade, quality standards, and ongoing border reforms, but the real test will be how these policies translate into everyday results. What matters now is whether Nigerian businesses, manufacturers, tech startups, farmers, and exporters can actually take advantage of this single African market. The agreement offers a massive opportunity, but it is the strength of our systems, the competitiveness of our industries, and how well the government and the private sector work together that will determine the outcome. Nigeria is not just participating in the trade bloc, it's preparing to shape it. The coming months will reveal how effectively we can turn this ambition into practical gains for jobs, export, and long-term economic growth. Nigeria is moving on multiple fronts: tightening tax compliance, pushing for lower borrowing costs, gaining global recognition for its products, and stepping into Africa's $3.4 trillion market. Each of these moves shapes how businesses operate, how trade flows, and how everyday Nigerians feel the impact. That's where we wrap up today's episode. I'm Olaitan Adebayo, and this is Market Square. Do well to follow us across all our social media platforms. Thank you for watching, and see you in the next one.